All right. Hello and welcome back to another episode of the Wealth Building for Dummies podcast. My name is Kyle Demian. I'm here with Renji Matthew, as always, and today we're going to be talking about 2025 market predictions. Now, this isn't going to be our predictions. We are going to be using information from a recent BCA research study. This is what they're predicting for 2025. And just as a disclaimer, this podcast will not be intended as any financial, legal advice. This is simply our inputs, our opinions on this article. We're going to be talking through, what this article predicts and what they're projecting. And we're going to talk about some different ways that you can potentially protect your money as well. But as a reminder, this is not intended as financial advice, simply financial education. So thank you guys for hanging out with us. And Renji, let's go ahead and start talking about this this prediction and this research study that came out. And tell us, what are they predicting is going to happen to the stock market in 2025?
Well, they're saying it's going to drop by 32%, which, again, this is a prediction because what did they say last year? They thought the market was going to crash this year, but the market actually did good, right? So it's good to be informed and to kind of keep an eye out. That way you can make changes if you need to. But I also think it's a lot of times people get too scared and take action rashly, and that could hurt them too. What are your thoughts?
Yeah, so they're predicting a 32% decline, which would be the largest decline since 2008, where the market was down 39%, almost 40%. And so they're predicting that a recession is going to come, and they're actually saying this might hit in late 2024 or early 2025. So obviously this is simply just a prediction and a projection, but they're basing it on a few different things. Reading their article here, they're saying that they expect the S&P to tumble down to about 3750. Right now, as of this recording, the market sits at about 5,500. So that would be about a 32% decline. So the idea is that the Fed will continue to drag its feet in cutting interest rates, and the central bank will only meaningfully lose financial conditions until a recession is apparent. So by then, it'll be too late. So they're saying that some of this is actually being brought upon because of the Fed not cutting interest rates, because of inflation seemingly to be higher and higher. And they do go on to talk about the jobs in the United States as well, and how the jobs report shows the unemployment rate ticking higher and higher to about 4.1%. So all of these economic conditions are what are starting to align, and why BCA is predicting that we're in line for another market crash. Now, obviously, like Renji just mentioned, there have been institutions in the past that have predicted these market crashes as well, and they've been wrong, and the market has done really, really well. But this is exactly why we talk about being diversified, right? And having your investments into multiple different areas, right? So Renji, talk to us a little bit about diversification, and what does that mean for you, and how important is diversification to different people?
So everyone has their different goals, right? So it really depends on people's individual goals. But I know for you and me, we like to get into passive income. So this is another reason why we love passive income, because we don't have to depend on what the economy is really doing. A little bit we do, but if you're getting into passive income, there's a lot more stability. There's still ups and downs, but there's a lot more stability. Then when it comes to retirement accounts, you want to make sure at least 50% of your assets are protected, especially if you're getting close to retirement. So that's where it becomes a big issue. Because if let's say you're 65, about to retire, and you have $1 million in your retirement accounts, if the market goes down 32%, that's $320,000 you're losing, right? So how much of that are you willing to take a risk with? What if you could protect half of that at least? That way, if the market goes down, you're still protected on at least 50% of your money. If the market goes up, you don't have to worry about it. But especially if when you're younger, you know, you're not thinking about retirement as much. You might be putting money away. You're not too worried about the market volatility because you have time for retirement. But when you're getting closer to the mid 50s and later, you're getting close to that retirement age. So you want to start thinking about, hey, how much of this can I protect? Because this is hard-earned money you've been saving up for years. So that's what's going to affect more people. Is a lot of times people don't care what the government's doing. They don't care what the market's doing, but they do care what their money is doing, right? Especially when they've been saving for years for retirement. Because we're seeing a lot of people either having to go back to work from retirement because their retirement income ran out, or they're having to work a lot later. They're having to work till their 70s, 80s sometimes because they don't have enough saved up, or their plans that they had didn't plan out, right? So those are the concerns I see more so than people caring about what each industry is doing, and people do care about those things, but not as much as what their money is doing, right? What are your thoughts on that?
Yeah, absolutely. If you're within about 5 to 10 years until retirement, I like to call that like the retirement red zone. You know, in football, as you're getting close to scoring a touchdown, you know, the last 20 yards, you get into the red zone where you're about to score, right? And your offensive philosophy as you're about to score in football typically changes as you get closer to the red zone because you got to be more protected over the football, right? But you're still trying to score. And that's the same aspect when you're getting within about 5 to 10 years of retirement. Your offensive strategy has to change. You've got to become more almost on the defense to prevent from a large market crash sending you back. And like Renji mentioned, I'm glad you said that. Yeah, a 32% decline in the market, if you had $1 million, is you losing $320,000, which is crazy and almost an unfathomable amount of money to lose in one given year when you have no control over it, right? Because your money's in the market. Now, if you're young, you're in your 20s, 30s, 40s, you've got time for the market to bounce back and come back. But if you're in your 50s and 60s, this should be a real conversation, and this should be something that you're having with a financial professional just to make sure that you're protected. Now, how can you protect yourself? What are some different options in different ways? Now, in an ideal world, you buy low and sell high in the market, right? That's what everybody talks about. That's what everybody tries to do when they time the market. And I just had this conversation, yesterday with the lady that, you know, she's talking about moving her investments and trying to time the market. And here's the thing, the best asset managers, the best money managers can't even time and predict the market. And they have all kinds of research, training, and experience. And so if those people can't do it as well, the average American can't do it either. As much as they think they can or they want to try, it's just simply impossible, because how do you know in the moment when the market is actually at its high and you should sell? Or how do you know in the moment that the market is actually at its lowest point? And think about it, to time the market to be at its lowest point, you would have to wait to the very bottom of the 2008 market crash when everybody else around you is freaking out and talking about the recession. Are we going to enter a depression? You know, when's the market ever going to come back? You have to time it just perfectly in the worst time of the country over the last 15 years, right? That's how long it would be since 2008. You would have to time the market just perfectly to get back in at the right time and to have the mindset that the market's going to come back up. Simply enough, it's nearly impossible to do. And the asset and the money managers that actually can outperform the market in any one given year, 99 times out of 100, they can't do it for a second year in a row. So all of that to say that I have talked to people before that think they can time the market, think they can move their money in and out of the market. What's much better than trying to time the market is just having your time in the market. Just stay in the market, ride it out. If you're close to retirement, that's when we should have these conversations about diversifying, because you don't want all of your eggs in one basket. And you should still stay grounded. Have some money at risk, have some money out of risk. and not in the market directly, right? So let's talk about some of those options, because most people don't even realize that like indexed accounts exist, right? Renji, we've talked to people a lot of times that they say, what, this exists? Why have I never heard about this? Why weren't I taught about this? Why didn't my employer teach me about this? And simply enough, employers and companies don't offer these type of index accounts. Some financial advisors aren't even licensed to offer these investment accounts or these index accounts. And lastly, advisors may be incentivized otherwise to not even mention it, not even talk about it, because it takes from their assets under management, right, Renji? So let's talk about that. What are some of these different index accounts, and how can people get access to them to protect their retirement money?
Yeah, so if you have money in an old 401k or even in your current IRAs, something that a lot of financial advisors do, especially if they're geared toward providing a complete service for their client, they also put partial amount of their money, especially when they're getting closer to retirement, into fixed indexed annuities or fixed annuities. These are pretty much IRAs that have a floor. So what that does is when the market goes up, you get the gains, but when the market goes down, you don't lose anything. And most companies that offer these, they have a cap. So your cap, there are companies that offer no caps too. So, and some of them have fees, some don't have fees. Especially when there's fees, there's some type of value they're providing back for that fee. So it just has to make sense for you. So if it makes sense for you to protect partial amounts of your retirement, especially when you're in your late 50s and older, getting closer and closer to that retirement time, it makes sense because you can't predict the market. Even experts can't predict it, right? Right. So as long as you take the steps to protect those accounts, you have a better fighting chance to retire with more income than a lot of people predict. But yeah, so it's a lot of it is depending on your goals. None of any accounts, it's not one size fits all, right? Even a 401k, it's not a one size fits all. No matter what type of account that's out there, it just depends on what your goals are, what you're trying to do for retirement. Because at the end of the day, if you have $1 million in your account, but you're not using it, is it worth much? It might be worth $1 million, but is it giving you the value you need by providing you income? Because what's the point in saving all this money to retirement if it's not providing you income while you're retired? Right? You could have $10 million in your retirement account, but if you're struggling to live in your retirement because you're not accessing it, what was the point? Unless you're planning to leave it as a legacy, if you're planning to live off of it and you're not accessing it, what's the point? And if you're not accessing it and the market's losing and you're losing it with it, again, what was the point of it all from the start, right? So you have to think about what your goals are, why you're trying to set these up. Is it for income purposes for yourself, or is it to leave a legacy for your family? And one of the good things about these annuities is they're also protected from probate. So if you pass away, you don't have to worry about it going to court. You have to place a beneficiary so it goes to them. So those are some of my thoughts. What do you think, Kyle?
Yeah. So, and another thing we haven't talked about yet is what happens if your retirement does lose 32% in one given year, right? Then you have to deal with the break-even burden, which means you may need a 45% rate of return just to get back to the point that you were before the crash, right? And so, for example, in 2008, when the market crashed and went down about 39%, the next year, the market returned 23%. The following year, the market returned 12%. So you still hadn't caught up to where you were pre-2008 yet. In 2011, the market basically broke even. And then in 2012, the market went up 13%, and you still would not have broken even yet from the 2008 crash. And then finally, in 2013, the market was back up another 29%. So it would have taken you 5 years just to get back to the point you were before that large market crash in 2008. So like these are what we're talking about, where especially if you're closer to retirement, if there is another large market crash like this could be pushing back your retirement date another maybe 3 to 5 or 6 years, just obviously depending on what the market does and what it continues to do, right? So a lot of stuff could possibly happen. Is it going to happen?
Yep.
We don't know. One thing that we also didn't talk about, if you guys haven't heard, there's a big election at the end of this year as well. Now, typically elections don't really, opposite of what most people would believe, elections don't really have too much impact on the market, at least historically looking over the last 3 to 4 elections. But who knows? Who knows what could happen this year? It seems to be like there's more divide ever that I've witnessed in the country between Democrats and Republicans. And so could that have an impact depending on who does get voted in? It could. Just historically, it hasn't shown that it has. But that is another thing to consider as well. And so if you guys are watching this video and you're concerned about your money, you're concerned about a market crash, reach out. Renji and I do offer one-on-one consultations. Once again, this video isn't intended to be financial advice. This is simply education. We can meet on a one-on-one basis to talk about what some of your options may be. And for that, on the YouTube here, we'll include a link below, or actually our social media. That might be the best way. If you guys want to plan some time to chat one-on-one, connect with us at our social media platforms, which we'll have linked here at the end. And also be sure to like and subscribe to our podcast. And with that, Renji, is there anything else that you want to wrap us up with and end us off for today?
Just that, figure out what your goals are and what you're trying to do for retirement. If you're not saving at all, then think about that. Maybe that's your first step, is to start saving, right? So, because if you're struggling right now, income-wise, what are you going to do in retirement when we don't know we can't predict what the market's going to do, what taxes are going to do. But we think overall taxes might be going up, right? So there's different things that's going to happen that you have to take into consideration. So if you're not putting money away for retirement now, then what are you doing? Are you getting into passive income assets? If you are, then that might be all you need to do, right? But if you're getting into retirement accounts, then there's also different things to take into consideration. What is your age? What is your income? How much? What is your number? How much are you wanting to retire with? All of these things are things you have to take into consideration. So stuff to think about, and you can reach out to us, like Kyle said, and we can have that conversation, at least to get you pointed toward the right direction.
Absolutely. Well, with that, thank you guys for tuning in to another episode of the Wealth Building for Dummies podcast. Hopefully you guys got a lot of education and information out of this. If we could ever be of any assistance to you, let us know. Drop your comments below in the chat. What do you guys think the market will do in 2025? And what do you think that you can do differently to maybe protect your money? Ask yourself that question as well. And we'll see you guys on the next episode. Take care.